morning, I'm Chris Beach and welcome to Charting the Markets on IG Live. And we're seeing some losses across the board for indices this morning, really taking some of the heat off markets after what's been, of course, a very impressive bounce, not just since October, but certainly since the beginning of the year as well. Earnings season, particularly the big tech stocks last week, really delivered more upside for equities. But it all came to a bit of a halt on Friday with that huge non-farm payrolls reading, which was so far ahead of expectations you couldn't see it. Really solid number across the board for the US economy, still roaring ahead, coupled with Jerome Powell's interview of the weekend to US television. Chances of a rate cut in March are now vanishingly small and likely to stay that way, really. And then overnight, we've had the Reserve Bank of Australia, the Australian Central Bank, come out and saying, actually, we don't think we're in too much of a rush to raise rates yet, and in addition to cut rates just yet. And in addition, they downgraded the growth forecast. So cautious tone from central banks all around the globe, I think, really. But they do suspect that the peak in inflation is past and that it's heading downwards. There's always a risk it could come back, and that, I think, explains the caution you're seeing in their commentary, that the time is perhaps getting closer when they can cut rates, but not yet. So that leaves markets high and dry a bit, particularly when, of course, if you think about the rally, particularly over the last month, a lot of it's been built on the idea that a March rate cut was on the cards. I always think that was a bit too much of an expectation, particularly from the Fed. But at the moment, the Fed is still pricing in 3 cuts this year of 25 basis points each. The market, I think, is still pricing in 4 or 5. So there's still a gap between the two, and that's likely to be where the volatility may arise from. Not a particularly busy morning so far. Just UK construction PMI today, this morning at 9:30. You get a bit more data this afternoon in Canada, but otherwise, with earnings, you get Ford today and Disney later in the week. But in many ways, the main part of earnings season is now behind us, with all due respect to those companies still reporting. The real headline grabbers, the likes of Apple and Amazon, Facebook, are now done, and it's just Nvidia left of the bit of the Magnificent Seven that needs to report, really. It's probably the last one that carries any sort of real headline weight. Important for the individual stocks concerned and for the sectors, but for the actual index, I think really a lot of the focus will now shift away from this. It's 40 days or so till the next Fed meeting as well. So markets do find themselves somewhat lacking in major catalysts for the time being. That's often the way, I think, particularly around the turn of the year. You get a lot of big events coming through, payrolls, Fed decisions, earnings, and then suddenly you're entering a quieter period in February and beyond. And historically, if you look at indices, we talk about seasonality a lot. We talked about it in Q4 when it really came to the forefront, how it's a big rally. You often see into the second half of February particularly, and then into March, even in election years in the US, weakness in indices. So in some ways, we're on watch for a pullback now, and perhaps that leads us in nicely to the indices, and we'll look at the Dow to start with, currently trading at 38,283. How's that for a seamless transition? But we are probably, as I say, on watch for a pullback. We don't know when it's going to happen. It's the kind of thing you really can't predict. Often a lot of people go on CNBC and Bloomberg and say we expect a pullback, but you really don't know when. But it makes sense after the huge gains of Q4 and indeed the gains of January, which have seen the Dow gain about 1,500 or so, to expect maybe some kind of short-term weakness, maybe as the earnings season comes to an end and we wait to see what the Fed will say. Something might develop. That said, as you can see from the price action here on the Dow, it's still within a whisker of record highs. We were at record highs on Friday, which was notching up. The actual high on Friday was 38,784. So we're 500 points away from that, but that's only about 1% and a bit for the Dow, really. So nothing particularly dramatic if it really wanted to move higher. So still within easy distance. Holding on to trendline support, as you can see from mid-January, or one form of trendline support. If that's broken, if you get maybe a reversal back below probably this area, I think it's fair to say, because over the course of the past 2 weeks or so, 38,100 for whatever reason, we saw the bounce stall there a bit before it then pushed higher, and then last week buyers came to defend the area, so close below there as well could really signal that we're due for a slightly more substantial pullback. Even if we drop from the current level straight to the 50-day moving average, that's still 2.5% really, and the next big area would be around 37,000, which is where, as I say, in mid-December and then into the middle of January as well, so we found support in that zone, really. So that would also put us back below the 50-day moving average for the first time since the end of October. So I think it illustrates how far this index has come. Don't forget the Dow is less driven by tech stocks than the S&P. The weighting for tech stocks in the Dow is lower than that for the S&P. So that's why it's not been quite as strong in some ways as the S&P. But that benefits it in other ways if the tech stocks begin to drop back a bit. So do watch that one. But the short term, just sitting on trendline support for the Dow. Going across to the Nasdaq, sitting happily, contentedly at record highs. Just off where we were yesterday. I think we've almost nudged up a new record high in early trading so far this morning. Still, no, not quite. Last Friday's record high, 17,682, call it. Short-term trendline support again from early January yet to be tested, whereas the Dow's testing trendline support, yet the Nasdaq 100 isn't. So close below that, down to the 50-day. Maybe we could see the start of a pullback. It's the kind of thing we just don't know. I think that's the unknown. The unknowing is what catches everybody, really. It could begin today. It could go on to push towards 18,000 and then start to pull back. But you should expect at some point every year a pullback of at least 10 to 15%, if not more. Some years you don't get it. But at the moment, with a lot of the news catalysts out of the way for the time being, even that, we could go either way. The lack of news could mean that we get a gentle drift higher. The lack of news could mean that stocks finally succumb to profit taking. If you are taking a bearish view, and it's hard, I think, at the moment on a view like this on a daily chart to argue for that bearish view, but at the moment you're really not seeing any kind of catalyst to drive that. I think you need a close below something like 17,000, back below the late December highs at 16,978 to take any kind of sort of short-term negative view. And even then, it's clearly in an uptrend, and therefore the pullbacks are likely to be limited. Even if it drops back towards, say, these early January lows, that's still only about 8%, which is entirely normal for any given year, so it wouldn't be too dramatic. It always feels more dramatic at the time, but at the moment, the buyers still in control, and we'll wait to see whether we get any kind of two-way movement over the next few days. But one where something is happening, something is moving for a change, is the Hang Seng. Chinese markets had an absolutely huge day overnight. The Shenzhen composite, on the mainland indices, was up over 6%. The Hang Seng was very respectable, 3.8%, I think, by the close, rallying off the lows we saw last week, and that was indeed a miracle of miracles, a higher high from where we were in the second half of January, around 15,000. So a kind of rearguard action being fought by the buyers here. Now, there's a lot of news coming out of China about support for the stock market. Chinese regulator getting state-owned enterprises to release funds to buy. I think it was like $17 billion worth to go into index funds last week. Overnight, we had reports that they would be encouraging companies to do more buybacks and to put more money to work in the stock market. You've had a cut in the bank's reserve ratio. So all the kind of things you might see in an attempt to chivvy up the stock market. Now, even the Chinese government, even the US government, can't really make the stock market go up purely by its own efforts. But it is notable that these headlines are coming through. It does show that maybe something is shifting. And it's also true that a lot of investor sentiment around China is really, understandably, given the losses, quite bearish at this point. You had a Bloomberg article overnight talking about how all the flows in funds are moving from China to India, which is the kind of thing you could expect to see around a medium-term and near-term low, a capitulation, if you like, in the selling. And that's maybe what we've got here. Certainly in the space of 2 weeks, you've had two big up days in a row, on the 23rd and 24th, and then now the 5th, and yet overnight, really, the 6th of Feb, taking us back above 16,000. Of course, this is the context of the move. We're still firmly in a downtrend, and volatility is part of the game, particularly in an index like the Hang Seng. You do see much wider volatility. And of course, if you're trading in the UK, you do often miss the busier sessions overnight. So you do have to be very careful with your risk management. But it is worth noting that even with the bounce here, we're still back to where we were just over a week or so ago. And that's still down, 25% from the highs, even from July in the summer. So huge losses here for the Hang Seng. It's not yet a turnaround in trend, but it is a bounce. We'll just have to see how far it goes. If it made another push higher, maybe we take it back to 17,000. That would be its highest level since the beginning of January. We'll see whether it's a start of a trend, but that's the only thing we can tell with hindsight. But certainly, as you would expect in a market that's going down, quite a lot of volatility around the lows and a very big bit of buying going on clearly overnight. We'll just have to wait and see whether it has legs. Turning to FX markets, euro sterling, as you can see here, dropping back a bit this morning after 2-3 strong updates, really. And the Bank of England's more hawkish view really not delivering much of a change at this point. I would say more hawkish, certainly they're very cautious about cutting rates, but not really doing much for the pound against the euro. Here, the euro making quite a bit of headway, albeit from this low, which was the lowest level here since August. So after a big pullback, it was natural, probably, unless the Bank of England had said we will raise rates 2 or 3 times this year, it was unlikely that you see much more downside in the short term for euro sterling. So at the moment, a bit of a rebound. Maybe it goes back to the 50-day moving average, and then from there, 86.15 was the area where the price tried to rally in mid-January and failed. So that's the first line to watch for. Of course, it's a downtrend. You've got declining 200-day moving average, declining 50-day, even the 100 days rolling over as well. So I would tend to sort of lean towards the downside view and say that as long as it stays below, say, 86.20, it's probably best to take a negative view for the time being and argue for a continuation of this downward move. Although that said, 85 and above has been a big area of buying since June, so there's clearly a lot of willingness to buy the euro down at these levels, even if the bounce is fairly limited in its duration. Australian Central Bank, the RBA, overnight saying that there's no expectation that they will cut rates anytime soon, although they're not planning to raise rates again. The risk is still there, they did say. They said also that inflation probably had passed its peak, but there's always the risk that it come back in. Again, there's that cautious tone from central bankers. And they also downgraded the growth forecast. So a busy time for the Australian Central Bank. Not much good news for the Aussie either. Of course, hit hard by the Fed's, because the US Central Bank was dialing down the chances of a rate cut in March and even beyond. You might argue that strengthened the US dollar, so that's why you've had this drop. What had been signs of perhaps a low forming in the Australian dollar here against the US dollar in late January, around say 65.80 or so. That was cancelled out last week, first by the Fed and then by non-farm payrolls report, which really knocked the Aussie to its lowest level since mid to late November against the US dollar. And no sign of a bounce here really either. Again, it would have needed the RBA to come out and say we're hiking rates twice or more this year to lift the Aussie. We didn't get that. So the overall bearish view seems to remain firmly in place. Even after the big move down, it looks like perhaps after some consolidation, we could be pushing further into these lows from October and November. And turning over to dollar yen, again, all about the stronger dollar. This looked like it was topping out last week, so the reverse of what we were seeing in Aussie dollar, US dollar. Dropping back towards 146 here, but strong bounce Friday. Again, there's the payrolls report. There's the impact being felt in markets. Everyone keen to go back into the US dollar and pushing a little bit higher for the time being here too. So it looks as if, again, the advantage has shifted back to the buyers, and we could be seeing first a move towards 149.70. If you look then going back further into October, beginning of October, 150 itself, of course, worth watching, and then the peak from November at 152, which will doubtless bring forth headlines about Japanese intervention in the market again. But that seems to be the way things are going. That's certainly level to watch on the upside. And again, brief trip below a rising 200-day moving average, and then it's back above it again. Buyers certainly taking control of this one resolutely, thanks to the Fed's turn, and seems that we're back on yet again. So this uptrend has survived another pullback, an even more dramatic one than was the case in July, and we're back to the upside once more. And then finally, commodity markets, and again, there's no escape from the stronger dollar, which is obviously a refrain across the board really here. Gold, again, looked like it was beginning to mount a decent rally after a tough period in January. It did drop below the 50-day moving average. It then started to recover. Last week, signs of some upside, even into the Fed meeting and beyond, it had rallied back above 2,000, but it was the payrolls that really did it. Knocking it back on Friday, back to the 50-day, and then yesterday let's go back below the 50-day moving average. The one hope, I suppose, for buyers is that it's now having broken trendline resistance to the upside. It's now pulled back and is testing it as possible support. If that holds, if you get a close back around 2014, maybe there's yet scope for another attempted bounce back above 2060 and potentially beyond from there. Wait and see, really. The next few days should probably tell us what happens next. Closed below 2010, below 2000 itself, clearly hands the advantage to the sellers. And then again, we've seen this uptrend really from November knocked back. If you look at it this way, you can argue for trendline support being broken in January and then a failed attempt to get back above it over the past week and then back to the downside. So a battle of the trend lines going on here, one to watch in gold prices. And then over to oil prices finally. After 4 big down days last week, trying to claw their way higher in the shorter term. So definitely one to watch as well. Can they mount a recovery here? Can Brent get back above $80? Because if it can, maybe there's yet hope that we get another attempt to push higher over the medium term. And this pullback is merely a reaction to the strong gains we'd had since mid-December. We did, however, break trendline support from the December lows. So you can argue for the sellers coming to action here. And if it certainly fails to get back above 78.90, then really, certainly back above 79, then you might also argue for more downside. Initially down towards 76, and maybe over the course of time down towards those December lows at 72.50. So looking ahead to the rest of the session, as I say, it's not a huge afternoon for data, just the Canada IV PMI this afternoon. Earnings from the likes of Ford, Chipotle, I think Hertz, the car rental company as well this afternoon, but nothing too earth-shattering, even Ford itself. Not quite moving markets in the same way as the earnings did last week. We're expecting a more muted open across the board for US markets too. The Dow expected us to start the day down around 70 points after its 200-point drop yesterday. So a cautious atmosphere still persists across markets. But that's it for me. Thank you for joining us. We'll see you again tomorrow as normal at 10:30.